In the last years, North American direct-to-consumer clear aligner category moved rather unpredictably, fighting off macroeconomic headwinds, higher shipping expenses, and even rising marketing and customer acquisition costs. During 2023 and 2024, the category witnessed major setbacks, including SmileDirectClub's bankruptcy and many other leading players exiting the direct-to-consumer category altogether.
InsightsZ estimates that the fall of the DTC segment wiped out more than $15 billion in value from the global markets between the period 2019 and 2024. September 2023, SmileDirectClub filed for bankruptcy 4 years after raising $1.35 billion in its IPO that once valued the company at $9 billion approximately. Even after going public, SmileDirect continued to behave in a way how one may expect a PE-backed private company to operate. In the first half of 2023, revenue declined by more than 20% on year-over-year basis, and net losses continued to stay out of control. And to make matters worse, there was no light at the end of the tunnel for SmileDirectClub, as the company still lacked a clear path to profitability, while significantly underperforming the global clear aligner industry. Founded in 2014, SmileDirectClub founders were originally focused on selling clear aligner treatment directly to patients, offering up to 60% price discount versus leading doctor-directed brand Invisalign. Traditionally, dental offices have had a considerably significant percentage markup selling clear aligner treatments to their patients. By positioning itself as a lower-priced solution and transferring the cost advantage to its users, thanks to its DTC approach, SmileDirectClub succeeded in generating the initial buzz. However, the brand failed to continue the growth momentum over the long term. In 2016, Align Technology bought 16% ownership stake in the company, which was later raised to 19%. However, that changed in 2019, after the two companies went onto a collision course when Align Technology allegedly violated the agreement terms and started opening their own version of Smile Shops under the brand Invisalign Store. Before things had turned sour, the two companies worked closely with each other as SmileDirectClub was equipping its retail outlets with iTero scanners and was relying on Align's manufacturing capabilities for its own label clear aligner production. Looking retrospectively, SmileDirectClub must have regretted its decision of forcing Align Technology to give up its equity stake in the company and the failed synergies that could have been realized in the business case. The company's customer acquisition cost continued to remain at unsustainably high levels, and markets realized that SmileDirect's marketing spend is not employed to grow the business, but rather spent on sustaining the next quarter. Later in the company's life cycle, when SmileDirect attempted to reduce its marketing spend by 30%, it led to a 15% decline in revenue growth, a clear indicator of poor top-of-funnel marketing performance. In other words, any cuts in marketing dollars disproportionately impacted the revenue performance on a negative basis. Eventually, it became clear that SmileDirect wasn't a growth stock, even though the company's marketing spend and financials looked like those of a high-growth company, wherein the customer acquisition costs were just too high. Once touted as the next Invisalign, SmileDirect's inability to grow had become obvious, as the company delivered successive quarters of negative year-over-year revenue growth, significantly underperforming Invisalign as well as the global clear aligner industry. SmileDirectClub's lackluster performance was underlined by a series of poor execution and failed product launches. The company's much-talked-about AI-based 3D scanning mobile app, SmileMaker, failed to deliver its promise of revolutionizing the customer journey and driving higher patient conversion. SmileDirectClub's much-hyped patient referral app was touted as a potential solution for shortening the customer acquisition tunnel. The app's pilot launch in Australia even forecasted a sizable reduction in cost per lead, and an overly optimistic prediction estimated that the app will enable the company to increase revenue while keeping its marketing spend under control by driving up conversion rates. In 2021, SmileDirectClub had to shelve its adrenaline-fueled, aggressive, and uncontrolled growth plans as the company had to take drastic steps, including shutting down its European expansion plans, as well as readjusting its retail presence commensurable with the market demand. The company's quality-related problems were widely known, and unhappy patients were forced to sign NDAs, basically tarnishing the brand's reputation beyond measure. Likewise, the company's commercial innovation, Care Plus, a premium aligner treatment, which delivered a higher touch treatment option by leveraging on both in-person and virtual patient management, value-added services, and concierge-level care from SmileDirect's network of licensed GPs and orthodontists, witnessed only limited success. The company's retail network, Smile Shop's footprint growth did not coincide with revenue increase, a proof that growing retail presence does not correlate with increasing top-line growth. In Q2 of 2022, SmileDirectClub was operating 117 Smile Shops. However, that number had shot up by 10%, scaling to a total of 128 outlets in Q2 of 2023. During this period, revenue growth remained flat, serving as another proof of the brand's lackadaisical performance and learning a painful lesson that retail footprint does not equal growth when the core economics are broken. During this period, even referrals, a key efficiency metric, remained flat as a percentage of aligner orders, showing no organic momentum. SmileDirectClub failed to accompany its users throughout the patient journey as they were left pretty much on their own, without the orthodontist or GP. Unlike other clear brands that were actively partnering with treatment monitoring service providers like Dental Monitoring or Get Grin, SmileDirectClub basically left the patients to their whims. While having access to patient information enabled SmileDirect to have intimate conversations with customers, nevertheless, poor outcomes, shoddy customer experience, missing touchpoints, and quality issues negatively impacted the brand image. The company's legal team coerced patients into signing NDAs as a perquisite to give money back, only left poor taste in the consumer's mouth, further negatively impacting the brand's customer referral rates and indirectly contributing to the rising disparity between the customer acquisition cost and lifetime value. And while the company took steps to improve its quality issues and the customer journey, however, it all came too late and too little. These struggles were not unique to SmileDirectClub, but DTC companies across the board, as they failed to provide value beyond the initial sale. Soon after, SmileDirectClub filed for bankruptcy in Q3 2023, Candid exited the DTC business, together with all 45 retail locations, so-called Candid Studios, and shifted to a B2B model, Candid Pro. SmileLove declared bankruptcy in 2021 after handling hundreds of complaints. Even SnapCorrect shut down operations in August 2024 due to unfulfilled orders and customer service issues. According to Better Business Bureau, they've fielded over 800 complaints about the company, and publicly available customer reviews reveal information about a series of denied refunds, unshipped orders, and absent customer service. Overall, poor product quality, lack of orthodontic oversight, and weak customer experiences created growing dissatisfaction, whereas legal tactics like requiring NDAs for refunds further eroded trust and referral rates. The billion-dollar lesson learned: selling cheaper aligners alone was not enough to build loyalty or long-term growth.